Right now, literally at this very second, 1/3 of everyone wearing contact lenses on Earth is walking around with a product manufactured by Cooper companies.
Yeah, which is just a staggering global footprint. But, the real story we're looking at today isn't actually just the lenses they're selling right now.
Right. The real story is what a new artificial intelligence system is telling them to, essentially not sell tomorrow.
Exactly. That and a multi-billion-dollar surgical division, they might be on the absolute verge of spinning off.
Welcome to the Deep Dive. We're taking you straight into the boardroom today, breaking down the Q2 2026 earnings call transcript for Cooper Companies, Inc.
And if you're tracking this in your own portfolio, we are looking at ticker symbol COO.
We have a very distinct mission for this specific Talk Tickers format. We take the corporate chatter, the prepared remarks, the analyst questions, and we distill it down to what actually matters for you.
We're going data forward, we're staying opinionated, and we're making this actionable for the retail investor.
Because the sheer volume of data embedded in this specific earnings call is just, it's staggering.
It really is. Management is dealing with complex global macroeconomic shifts, a massive litigation settlement, and a fundamental restructuring of their supply chain.
Our goal here is to translate all that Wall Street jargon into plain, accessible language. We want to map out the underlying mechanics of how this business is actually operating under the hood.
So let's just start by looking at the scorecard.
Yeah, let's hit the headline numbers for the second quarter of 2026, because they paint a picture of a company operating at serious scale.
They do. Cooper Companies reported consolidated revenue of $1.08 billion for the quarter.
And management was very quick to highlight that crossing that billion-dollar threshold in a single quarter, that represents a record for the company.
Right, a huge milestone. That $1.08 billion translates to an 8% increase year over year on a reported basis.
But only a 5% increase organically, right?
Yeah, 5% organically. And for anyone tracking global conglomerates, that spread between reported and organic is vital.
Because reported is simply the raw math, right? Like what came in the door this year versus last year.
Exactly. But organic strips out all the noise. It removes the impact of fluctuating foreign exchange rates.
And any revenue they basically bought by acquiring other companies during the year.
Right. It tells us how the core business, the assets they already owned 12 months ago actually performed.
And honestly, a 5% organic growth rate for a mature medical device company of this size, that is a very solid baseline.
It's extremely healthy. But the top line is only half the story. The bottom line is where the leverage really shows up.
Yeah, let's talk about that. Their non-GAAP earnings per share, or EPS, came in at $1.21.
And we should probably clarify for everyone that non-GAAP adjustments are a way for companies to strip out one-time charges.
Like the massive litigation settlement we'll get to later.
Right, exactly. Stripping that out gives you a clearer view of the ongoing operational profitability of the actual business.
So that non-GAAP EPS of $1.21 represents a massive 26% year-over-year increase.
Which is huge. Revenue grew by 8%, but earnings per share outpaced it dramatically, growing by 26%.
And this actually marks the company's 10th consecutive quarter of beating consensus earnings expectations.
10 quarters in a row.
A 10-quarter streak is essentially 2.5 years of consistently telling Wall Street analysts they're going to hit a target and then over-delivering.
Right, which builds a tremendous amount of institutional trust, and that often creates a premium on the stock price.
Because the market is willing to pay more for a company that just doesn't miss.
Exactly.
Okay, but looking at that gap between 8% top-line growth and 26% bottom-line growth, I want to play the skeptical retail investor here.
Go for it.
10 consecutive beats and a 26% EPS jump sounds almost too good. Is this purely operational excellence, or did they get a lucky break somewhere?
That is the exact right question to ask. The transcript points to two separate drivers for that EPS jump. One is operational, but one is purely macroeconomic.
Okay, let's start with the operational side.
Management explicitly credited their back office consolidation and efficiency initiatives. Over the past year, they went through a significant reorganization.
Centralizing functions like HR, IT, and finance, right?
Yeah. And the data shows that their operating expenses only rose 1% year over year.
Wow. So when your revenue grows 8% and your expenses only tick up 1%.
Almost all the profit from those incremental sales flows directly to the bottom line. Their operating margin expanded to 27.5%.
And operating income increased by 19% overall. It's the classic operating leverage model.
Exactly like a restaurant. If you serve 8% more meals but don't have to turn on extra lights or hire another manager, those extra meals are disproportionately profitable.
Okay, so that's the operational win. But you mentioned a macroeconomic driver as well, the lucky break.
Right. The CFO, Brian Andrews, was very transparent during the Q&A about the foreign exchange environment.
FX is such a huge deal for global companies like Cooper.
It dictates so much of their quarterly math. When the US dollar weakens against the currencies where they sell their products like the euro or the yen, the revenue they generate overseas translates into more US dollars.
When they bring it back home to report earnings.
Exactly. And this FX tailwind gave them an 8-cent per share favorable impact in Q2.
So that currency math really helped pump up that massive 26% EPS jump.
It did. And management anticipates that this specific tailwind is actually going to reverse. It'll become a headwind in the second half of the year as the dollar strengthens.
Okay, so we have a record revenue quarter, a 10th consecutive earnings beat, and incredible margin expansion aided by a temporary currency tailwind.
That's the 10,000-foot view, yeah.
But to figure out what is actually driving that $1.08 billion, we really need to look under the hood at their two main divisions. Let's start with their core business, CooperVision,
which is the contact lens division. They delivered revenue of $724 million for the quarter.
Up 8% reported and 4% organically.
Right. And the geographic breakdown shows strong momentum in their largest markets. The Americas grew 7%, and the EMEA region, Europe, the Middle East, and Africa grew 6%.
The CEO, Al White, noted that they remain the absolute market leader. Roughly 1/3 of all global contact lens wearers are utilizing a CooperVision product.
But maintaining a 33% global market share requires, well, constantly cannibalizing your own older products with newer technology.
Yeah, the contact lens market has evolved dramatically from those rigid gas permeable lenses we used to see.
Oh, absolutely. The primary shift driving their current growth is the consumer transition from legacy hydrogel lenses to daily silicone hydrogels.
And their flagship brand in that premium category is MyDay, right?
Yeah, MyDay, which delivered double-digit growth this quarter. And the science behind this shift really comes down to oxygen permeability.
Right, the DKD value.
Exactly. The cornea actually doesn't have its own blood supply. It relies on absorbing oxygen directly from the air.
Which is wild to think about.
It is. And older hydrogel lenses relied entirely on their water content to transmit that oxygen. But the problem is water evaporates throughout the day,
leading to those dry, scratchy, uncomfortable eyes by 5 p.m.
Right. Silicone, on the other hand, is inherently highly permeable to oxygen.
So it's basically the exact opposite approach.
Yeah. Silicone hydrogel lenses allow up to 5 times more oxygen to pass through to the cornea compared to traditional hydrogels.
Wow, 5 times.
Which drastically reduces the risk of hypoxia, where blood vessels actually start growing into the cornea trying to find oxygen.
Yikes. So because they allow so much more oxygen through, you can wear them much more comfortably for longer hours.
Exactly. Which modern consumers absolutely demand. Management also highlighted the strong performance of their Energies lenses, which are designed to combat digital eye strain.
Oh, that plays directly into the macro trend of just, well, modern work. We were all staring at screens for 8 to 12 hours a day.
And the mechanics of that are fascinating. When you stare at a screen, your blink rate drops significantly, causing dryness.
And the ciliary muscles in your eyes are just locked into a continuous state of contraction to focus on that screen.
Right. So if a lens can alleviate even a fraction of that fatigue, consumers view it as a necessity, not a luxury.
But beyond the standard adult vision correction, the transcript reveals an incredibly aggressive push into pediatric care.
Yeah, with a product called MySight. And this is arguably the most important long-term growth vector in the entire CooperVision portfolio.
It's a pediatric myopia control lens.
Right. For the quarter, MySight grew an astonishing 24% to hit $32 million in revenue.
Wait, 24% growth in a single quarter?
Year over year for the quarter, yeah. To understand why it's growing that fast, you have to look at the global myopia epidemic.
Myopia, meaning nearsightedness.
Exactly, but it's not just a matter of blurry vision that needs correction, it is an anatomical issue. In a myopic child, the eyeball literally grows too long from front to back.
Axial elongation.
Right. And when the eyeball is too long, the light entering the eye focuses in front of the retina rather than directly on it.
Causing everything in the distance to look blurry.
And the incidence of childhood myopia is just skyrocketing globally. It's largely attributed to kids lacking outdoor time and doing excessive near work on tablets and phones.
The real danger, though, is that high myopia significantly increases the risk of severe eye conditions later in life, right? Like retinal detachment or glaucoma.
Exactly. It's a serious medical concern. And MiSight is revolutionary because it is FDA approved to actually slow the progression of myopia in children aged 8 to 12.
Okay, I have to stop you there. How does a soft contact lens physically stop an eyeball from growing?
It's wild, right? It utilizes an optical phenomenon called myopic defocus.
Okay, break that down.
The MiSight lens features this unique concentric ring design. The center of the lens perfectly corrects the child's vision so they can see clearly, just like normal.
Okay, so they can see the chalkboard.
Right. But the alternating rings around that center intentionally bend peripheral light to focus slightly in front of the retina. This creates a visual cue, an actual biological signal that tells the eye to slow its axial growth.
That is incredible. And does it actually work?
Clinical trials over a multi-year period showed that MiSight slows the progression of myopia by roughly 59% on average.
Nearly 60%. The commercial implications of that are just staggering.
The CEO noted this could become a market as ubiquitous as childhood braces.
I mean, think about it. If a parent is told their child's vision is going to deteriorate rapidly, and there's an FDA-approved daily lens that cuts that deterioration in half.
The price elasticity of demand is incredibly low. Parents will find the money.
Right. Management mentioned they are running national consumer marketing campaigns targeting parents during the back-to-school season.
Because once a child is fitted with MiSight, it's a compounding annuity of revenue. They are locked into the CooperVision ecosystem for years.
Okay, so the Americas and Europe are adopting these premium technologies rapidly, but the transcript reveals a pretty significant drag in the Asia-Pacific region.
Yeah, this was the problem child of the quarter. CooperVision revenue in Asia-Pac actually declined by 6%.
A 6% decline in a region that has historically been a massive growth engine stands out like a sore thumb, especially compared to the 7% growth in the Americas.
Management broke that Asia-Pac decline down into two distinct issues: a strategic internal shift and a really difficult macroeconomic reality.
Let's hear the internal shift first.
Internally, Cooper is actively rationalizing their portfolio in the region. They are intentionally phasing out their older, lower-margin legacy hydrogel products.
Trying to force the market to transition to the premium silicone hydrogels.
Right. And when you discontinue a popular legacy product, you inevitably face some short-term sales friction. Consumers have to figure out their next move.
But that's not the whole story.
No, the larger headwind is broad consumer market softness, particularly in Japan and China.
I think the best way to understand this is through the lipstick effect, combined with how the Asian contact lens market is structured.
Oh, the distribution channels are completely different.
Exactly. In the U.S., contact lenses are strictly regulated medical devices. You need an updated prescription from an optometrist every single year.
But in many parts of Asia, contact lenses act much more like a consumer discretionary purchase. There's a massive e-commerce market for them.
Right. Consumers have far more autonomy, which means they react much faster to macroeconomic pressure.
Exactly. If a consumer in Japan feels an economic pinch, they don't stop needing vision correction, but their behavior changes to preserve cash.
They might stretch a daily disposable lens into 2 days of wear.
Or delay buying a new box and just wear their backup glasses for a few weeks.
Or, to your point about the internal shift, they might resist Cooper's attempt to upgrade them to a premium lens and just buy a cheaper local competitor's legacy lens instead.
And that economic pinch is just starving the recurring revenue loop right now.
Analysts really pushed management on the timeline for this headwind, didn't they?
They did, and management was clear that they expect this Asia-Pac drag to persist, potentially through the end of 2027.
Wow. Over a year. It's a stark reminder that even a sticky medical product isn't immune to a consumer slowdown when e-commerce removes that clinical friction.
Exactly. So that's the vision side. Shifting gears, we need to look at the other half of the business, Cooper Surgical, or CSI.
Which delivered revenue of $358 million, up 8% reported and 6% organically.
And the absolute standout engine within this division was their fertility business. It grew a massive 10% organically to hit $144 million.
The underlying macroeconomics drivers of the fertility industry are fascinating because they are entirely demographic.
The CEO spent a huge portion of the call discussing global fertility trends, pulling in data from the CDC.
And the data paints a really complex picture. The U.S. fertility rate fell in 2025 to a new annual low of roughly 3.6 million births.
At first glance, a shrinking overall birth rate seems terrible for a fertility business.
Right, but the composition of those births is where Cooper Surgical finds its massive total addressable market.
Yes. Women aged 30 and older now comprise 53% of all births in the U.S.
And even more striking, for the first time in U.S. history, more babies were born to women aged 40 and above than to women under 20.
That specific demographic shift delayed childbirth is the entire foundation of the modern fertility industry.
Because as women delay childbirth into their late 30s and 40s, the natural biological ability to conceive declines sharply.
Right. The necessity for assisted reproductive technology, specifically IVF, increases exponentially with age.
So the shrinking overall birth rate is actually masking a booming high-margin market for clinical fertility assistance.
And the financial barriers to these treatments are eroding, too. Management highlighted that in California, starting this past January, most large group health plans are now mandated by law to cover IVF.
As insurance coverage expands, the volume of patients entering clinics just surges.
And Cooper Surgical provides the underlying technology, the equipment, the consumables that these clinics rely on.
That 10% organic growth was heavily driven by capital equipment sales, right? Specifically something called the Witness System.
Yeah, let's dive into the mechanics of the Witness System because it illustrates exactly why Cooper is dominating this niche.
An IVF cycle is incredibly expensive. We're talking $15,000 to $30,000 out of pocket for a patient.
It's physically, emotionally, and financially exhausting.
And the absolute worst nightmare for any fertility clinic, an event that will result in catastrophic lawsuits and destroy their reputation, is a lab error.
Fertilizing the wrong egg with the wrong sperm or transferring the wrong embryo.
The liability is immense. So historically, clinics relied on double human witnessing.
Right. Two embryologists physically looking at the petri dishes and verbally confirming the names written on them at every single step.
But the Witness System eliminates the human error element entirely, doesn't it?
Yes. It uses radio frequency identification, or RFID. Every single dish, tube, and piece of labware associated with a patient is tagged with an RFID chip.
And your workstations have readers.
Exactly. If an embryologist accidentally brings samples from two different patients into the same workstation, the system instantly detects the mismatch.
It sounds an alarm.
It sounds an alarm, and it can even lock down the equipment to prevent the procedure from moving forward.
It's basically an operational necessity at this point.
Oh, completely. If a clinic down the street is marketing that they use an automated RFID system to guarantee safety, every other clinic is forced to upgrade just to remain competitive.
And from a business perspective, it operates on that beautiful razor and razor blade model.
Yep. Cooper sells the expensive capital equipment, the RFID readers, to the clinic.
Which then locks that clinic into buying the proprietary RFID tagged consumables from Cooper for every single cycle they run for years.
Brilliant business model. Now, while fertility is booming, we also saw solid performance in their office and surgical products division.
That reached $214 million, up 4%.
And the focal point here is Paragard, their copper intrauterine device. Revenue for Paragard was technically flat for the quarter.
But management went out of their way to frame flat revenue as a major victory.
They did because it was against a highly difficult year-over-year comparison.
Right. Last year, they experienced a massive surge in Paragard sales, driven entirely by the launch of a new single-hand inserter.
Placing an IUD used to be a much more cumbersome process for the physician.
So they engineered a more ergonomic, single-handed delivery mechanism. It made the procedure faster and easier, which temporarily spiked demand as clinics upgraded their stock.
And to maintain that elevated level of sales a year later, rather than seeing a drop-off, proves that the new inserter permanently captured a higher baseline of market share.
The transcript also revealed a pretty strange, localized anomaly regarding the Middle East for the surgical division.
Oh yeah, they saw a unique late-quarter boost in orders from distributors in that region.
Due to heightened geopolitical tensions, airspace in the Middle East had been heavily restricted, disrupting supply chains.
When the airspace finally reopened, distributors aggressively ordered massive amounts of inventory.
Basically hoarding supplies to ensure they could operate through any future disruptions. It's a fascinating real-world example of geopolitics hitting the quarterly reporting.
It really is. So we've established that the core engines of vision and surgical are sound.
Yes, but we have to address the massive $250 million elephant in the room.
The litigation charge.
Right. The transcript details a devastating litigation charge. And to understand this, we need to trace the history back to December of 2023.
In December 2023, Cooper Surgical had to initiate a voluntary global recall of 3 specific lots of their embryo culture media.
Culture media being the highly specialized, nutrient-rich fluid used in the IVF lab.
Right. After an egg is fertilized, the embryo has to develop in a petri dish for 3 to 5 days before implantation.
It requires a very precise chemical environment to survive. The culture media acts as a surrogate for the human reproductive tract.
It contains a precise balance of amino acids, glucose, and crucial ions like magnesium.
And if that fluid is unbalanced or has impurities, the embryo will arrest. It stops growing and dies.
Which is exactly what happened. The recall was initiated because those specific lots were lacking adequate levels of magnesium,
leading to arrested embryo development across multiple clinics globally.
The emotional devastation for those families immediately triggered a wave of complex claims and massive lawsuits against Cooper,
alleging severe damages associated with the destruction of their embryos. And for months, this has been an existential dark cloud over the stock.
Institutional investors despise uncertainty and undefined legal liability in the highly emotive fertility space. That's the ultimate uncertainty.
Analysts couldn't build accurate models because they had no idea if the payout would be $50 million or $1 billion.
Right. But during this earnings call, management finally ripped the Band-Aid off.
They announced a breakthrough in the negotiations, taking a $271.6 million net charge to the quarter's earnings to resolve over 95% of the claims.
The mechanical breakdown of that number is important. The total accrued settlement was actually $324.1 million.
But they secured $52.5 million in insurance recoveries to offset it.
Bringing the net cash hit down to $271.6 million, they excluded this from their non-GAAP earnings, treating it as a one-time event.
But that cash will absolutely be leaving the balance sheet.
It will. But honestly, the reaction from Wall Street has been overwhelmingly positive.
Why is Wall Street cheering for a $250 million loss?
Because by taking the hit and settling 95% of the claims, management has quantified the worst-case scenario. The uncertainty is gone.
They've ring-fenced the liability and de-risked the stock.
Exactly. And more importantly, clearing this legal overhang was an absolute prerequisite for the massive corporate restructuring they want to execute next.
Right. You can't sell a house if there's a massive lien on the title.
And you can't sell a medical device division if it's bogged down in undefined class action lawsuits.
Okay. So clearing that legal hurdle paves the runway. Let's look at what management is forecasting for the remainder of 2026. Did that 10th consecutive earnings beat translate into an upgraded forecast?
They provided updated full-year guidance, and it really highlights the cross-currents the business is navigating.
Let's hear the numbers.
For full-year revenue, they updated the range to $4.28 billion to $4.32 billion.
And within that, they actually lowered the guidance for the CooperVision business slightly.
Right, just slightly, yeah. A direct result of that ongoing macroeconomic weakness in the Asia-Pac region, the Cooper Surgical revenue guidance remained unchanged.
Okay, a slight revenue haircut makes sense, but the analysts on the call zeroed in entirely on the EPS guidance.
Oh, they hammered them on it. Management maintained their full-year EPS guidance at a range of $4.58 to $4.66.
Wait, they beat the second quarter by 11 cents, putting up 26% growth, but they refused to raise the full-year target. To a retail investor, that math implies management expects the second half of the year to be significantly worse than previously modeled, dragging the average back down.
The analysts peppered the CFO with questions about this conservative stance, and the explanation lies in 2 specific headwinds hitting the P&L in the third and fourth quarters.
The first one is that reversal of the foreign exchange environment we talked about.
Right. The CFO noted the currency tailwinds will flip and become decently negative in the back half. Management needed to hold the guidance steady to force Wall Street to update their models for the stronger dollar.
So the currency math is out of their control. But the second headwind is highly intentional, isn't it?
Very intentional, and it showed up as a stark warning about their upcoming profitability metrics.
The CFO explicitly warned that third quarter gross margins are expected to plunge to roughly 66%.
A sudden drop in gross margin is usually an alarm bell. It usually means pricing power is collapsing or raw material costs are soaring.
Management cited the unfavorable FX and higher global freight costs. But the primary driver is actually an intentional reduction in manufacturing volume at CooperVision.
Directed by a newly implemented AI-enhanced inventory control system.
Okay, the concept of an artificial intelligence system intentionally damaging a company's gross margin requires a serious deep dive into supply chain mechanics.
Yeah, to understand why they have too much inventory now, we have to look back at the post-pandemic environment. Supply chains were shattered.
And at the same time, the European Union implemented stringent new medical device regulations, or MDR,
which threatened to slow down the certification of medical products. So to protect themselves, Cooper aggressively overproduced,
building up massive stockpiles of contact lenses globally so they'd never stock out.
But building that mountain of inventory ties up massive amounts of working capital. Cash is just trapped in the form of silicone sitting on a shelf.
So to unwind this, they deployed this sophisticated AI software to optimize their supply chain.
The AI analyzes real-time demand, shipping times, regional trends, and the output was clear.
Stop manufacturing so many lenses and draw down the existing warehouse stockpiles.
Right. But slowing down the manufacturing lines triggers a brutal accounting reality known as fixed overhead absorption variance.
Walk us through the math on that.
Imagine a massive CooperVision plant. The rent, taxes, electricity, the robots, those are fixed costs. Let's say they're $10 million a month.
Okay, $10 million.
If the factory runs at max capacity and produces 10 million lenses, the fixed cost absorbed by each lens is $1.
Makes sense.
But if the AI tells the manager to cut production in half, they only produce 5 million lenses. The factory still costs 10 million a month to run.
So the fixed cost absorbed by each individual lens suddenly spikes to $2.
Exactly. The cost of goods sold increases artificially, driving the overall gross margin percentage straight down to 66%.
So management is knowingly taking a short-term hit to profitability because the long-term cash generation is the real prize.
Precisely. By managing inventory tighter and refusing to spend cash buying raw materials, their free cash flow profile changes dramatically.
The proof is in the guidance. Despite the gross margin warning, they increased their 2026 free cash flow outlook to $650 million.
And they reiterated a long-term goal of generating $2.2 billion in free cash flow between 2026 and 2028.
So the temporary margin dip is the bitter medicine required to unleash all that cash.
Exactly.
But, the cash they generate from operational efficiency pales in comparison to the capital they might realize from the most critical catalyst discussed on this call.
Oh, the strategic review of Cooper Surgical. This is the focal point that will dictate the stock trajectory for the next year.
The CEO announced they are in active, advancing discussions with multiple parties to potentially sell the entire Cooper Surgical business.
Not a partial spinoff. The entire division, including the fertility engine and Paragard.
Historically, the prevailing wisdom for medical device conglomerates was diversification, right? Keep vision and surgical bolted together.
Yeah, if contact lenses slumped during a recession, surgical revenue provided a ballast to keep the numbers stable.
But the financial landscape has fundamentally shifted, and the resolution of that culture media litigation removed the final roadblock to a transaction.
The driving force behind selling a highly profitable asset like the fertility business comes down to valuation arbitrage.
Public markets versus private equity.
Exactly. The CEO's language was incredibly blunt. He stated that the current valuation of Cooper companies in the public markets is absurd.
When a CEO uses the word absurd to describe their stock price on a recorded call, they are sending a huge flare up to the market.
He's basically arguing that Wall Street is applying a conglomerate discount. The public markets are valuing Cooper based on a blended multiple.
But the underlying fertility business is a high-growth, high-margin asset operating in a demographic boom.
And private equity firms are currently sitting on record amounts of undeployed capital or dry powder.
There is a massive appetite in the private markets for women's health and fertility assets.
Because of that expanding total addressable market and the recurring nature of the clinical consumables, a PE consortium is willing to look at Cooper Surgical standalone and pay a massive premium.
Potentially 20 or 25 times earnings, right?
Yes. The public markets simply refuse to assign to a broader contact lens conglomerate.
Management noted they have received robust interest from multiple parties.
If a PE firm is willing to overpay for the surgical asset relative to its implied value within the current stock price, management has a fiduciary duty to shareholders to take the deal.
Which brings us to capital allocation. If Cooper sells a division generating nearly $1.4 billion in annual revenue, they are going to receive a massive windfall. What do they do with the cash?
Management explicitly stated that while their share buyback activity was muted this quarter due to the litigation negotiations, they intend to be significantly more active moving forward.
If the surgical unit is sold, the vast majority of the proceeds will be aimed directly at share repurchases.
And the mechanics of a share buyback at this scale are incredibly accretive for the retail investor.
Walk us through why.
If Cooper takes billions of dollars and systematically buys its own stock on the open market, those shares are retired. The float shrinks significantly.
The total number of shares available to be traded just drops?
Right. So even if the remaining standalone CooperVision business doesn't grow its net income by a single dollar next year, the earnings per share will skyrocket.
Because that net income is now divided among a vastly smaller pool of outstanding shares.
Exactly. It artificially but permanently forces the stock price higher to reflect the concentrated earnings power.
A post-transaction Cooper companies would be a radically different investment vehicle.
You'd be looking at a highly focused, pure-play global contact lens powerhouse.
An absolute cash-generating machine with a clean balance sheet, completely free of the medical device litigation risks associated with the surgical unit.
So we've analyzed the core data, the demographic macro trends, the technological shifts, the localized economic drag in Asia, the AI-driven margin compression, and this massive valuation arbitrage play.
Right. We need to synthesize this information into our Talk Tickers framework. Based on the totality of the transcript, what is your ultimate verdict?
Looking at the underlying fundamentals and the strategic maneuvers management and executing, the data points to a decisively bullish stance on Courtiers.
Even with the negative headlines.
The negative headlines are real, but they're transient. The gross margin compression down to 66% is painful, but it's an intentional, mathematically sound decision to optimize working capital.
And the macroeconomic drag in Japan and China.
It's going to weigh on top-line growth for the next 12 to 18 months, yeah. But it doesn't represent a structural failure of their product technology.
And the $271 million litigation charge.
It's a massive sum of capital leaving the building, but the certainty it provides is invaluable.
So the bullish thesis really rests on the resilience of the recurring revenue engines and the impending corporate catalyst.
Exactly. The contact lens business is arguably one of the stickiest consumer healthcare models in existence.
Once a consumer is fitted with a highly breathable silicone hydrogel daily lens, the switching costs are just too high.
The inconvenience of trying new brands is too great. They simply keep buying. And the MiSight myopia control product guarantees decades of customer lifetime value.
So if you are holding or considering initiating a position in the stock today, the actionable takeaway is to focus entirely on the valuation arbitrage.
The market is currently pricing Cooper companies as a slightly sluggish conglomerate dealing with Asian headwinds.
It is not pricing in the massive cash influx and subsequent share reduction that will occur if the Cooper surgical business is sold to private equity.
Right. The management team is actively engineering a multi-billion-dollar value unlock.
So don't get shaken out of the position by the noise of a temporary margin dip or the cleared litigation settlement.
You're essentially buying into a world-class pure-play vision business and holding a free lottery ticket on a massive premium buyout of the surgical division.
Management is pulling the right levers to force Wall Street to recognize the true intrinsic value of the underlying assets. But before we wrap up, I want to leave you with one final, slightly provocative thought to analyze on your own.
Let's hear it.
It looks at the narrative management constructed around their profitability metrics. We spent time detailing how the CFO blamed the upcoming plunge in gross margins entirely on this new AI-enhanced inventory control system.
Right. The narrative is that the AI is brilliant, realizes they are holding too much inventory, and tells them to slow down the lines.
Which mathematically destroys gross margins today, but structurally improves cash flow tomorrow.
Artificial intelligence is the ultimate corporate buzzword right now. Every executive team is searching for ways to insert AI into their earnings scripts.
To signal to Wall Street that they are at the cutting edge. And it is an incredibly convenient narrative to explain away a collapsing gross margin.
Oh, very convenient.
So the question you should ponder is this genuinely a highly sophisticated technological upgrade that is perfectly optimizing their supply chain? Or is invoking the specter of an infallible AI just a very convenient modern scapegoat used to mask a simpler, more troubling reality.
Like a fundamental miscalculation in demand forecasting.
Exactly. Or a forced production slowdown, because consumer demand globally is actually softer than they are willing to admit.
The proof will be in the balance sheet.
When they report their fourth quarter earnings, track their inventory levels meticulously. If the inventory genuinely plummets and the free cash flow surges to that $650 million target, the AI is a genius.
But if the inventory remains bloated and the gross margins stay depressed, the AI narrative might just be cover for operational friction.
That brings us to the end of our analysis. Thank you for joining us on this deep dive into Cooper companies.
We hope this breakdown translates the corporate complexity into actionable insight.
Keep questioning the narrative, monitor those upcoming catalysts, and stay curious.